Assets can look strong on the balance sheet but still be overvalued. IAS 36 exists to stop that from happening. Assalamu alaikum everyone. I'm Rehan, an associate accounts executive at HBCS, and in this video we'll break down how and when assets must be impaired, how recoverable amount is calculated, and why goodwill impairment is one of the most tested accounting topics. Before we go into the technical details, let me ask you one simple question. What is the point of showing an asset in the balance sheet if it cannot generate enough benefits anymore? That is why IS 36 is so important. It prevents companies from overstating assets. It directly affects profits and equity, and it is heavily tested in exams, especially when goodwill is involved. IS 36 connects accounting numbers with economic reality because honestly, an asset is useless if it cannot recover its value. Here is how today's session is structured. First, we'll start with a clear definition of IAS 36. Then we'll look at the scope, what assets are included and excluded. After that, we'll go through the core accounting rules, followed by the impairment model, step by step. We'll also solve a numerical example, discuss common mistakes, and finally wrap up with a quick recap. So by the end of this video, you'll have a complete picture of IAS 36. Defining simply, IAS 36 ensures that assets are not shown at more than what they can actually recover. If an asset's carrying amount is higher than its recoverable amount, IAS 36 requires us to recognize an impairment loss. And if conditions improve later, IAS 36 also explains when impairment can be reversed, except for goodwill. So, what do we actually mean by impairment? An asset is impaired when its carrying amount is greater than its recoverable amount. This tells us that the asset will not generate the economic benefits we originally expected. When this happens, we recognize an impairment loss. In simple terms, impairment reflects a decline in the economic value of the asset. IAS 36 applies to most non-current assets. This includes property, plant and equipment, intangible assets, goodwill, and even investments in subsidiaries, associates, and joint ventures when they are shown in separate financial statements. It also applies to cash generating units or CGUs, which we'll discuss in detail later. Equally important for practice or exams is knowing what IAS 36 does not apply to. Inventories, deferred tax assets, employee benefit assets, financial assets, investment property measured at fair value, biological assets at fair value, and assets held for sale are all excluded. These items follow their own standards. Doing a quick scope can save you from unnecessary mistakes. IAS 36 has four core areas you need to remember: recognition, measurement, presentation, and disclosure. Everything in IAS 36 revolves around one key concept: the recoverable amount. Once you understand recoverable amount, the rest of the standard becomes much easier. Impairment is recognized when the recoverable amount is lower than the carrying amount. Normally, impairment losses go to profit or loss. However, if the asset was previously revalued, the loss may go to other comprehensive income, but only to the extent of any revaluation surplus. And remember this golden rule: goodwill impairment is never reversed. To measure impairment, we calculate the recoverable amount. Recoverable amount is defined as the higher of fair value less costs of disposal and value in use. This is very important. We always choose the higher value, not the lower one. If either of these values is higher than the carrying amount, then there is no impairment. Fair value less costs of disposal represents the price we could get from selling the asset in an orderly transaction minus any direct selling costs. These costs include things like legal fees, stamp duty, or removal costs, etc. It is a market based measure and reflects what external buyers are willing to pay. Value in use is different. It focuses on how the entity itself uses the asset. It is the present value of future cash flows from using the asset and eventually disposing of it. We use a pre tax discount rate and we exclude financing cash flows, tax cash flows, and uncommitted future restructurings. This ensures the calculations reflect the asset's current condition. When impairment is recognized, the carrying amount of the asset is reduced. The impairment loss is recognized in profit or loss or other comprehensive income, depending on the asset. Future depreciation is adjusted based on the new reduced carrying amount. In CGUs, goodwill is always reduced first. IAS 36 also places strong emphasis on disclosure. Users should be able to understand which assets or CGUs were impaired, how much loss or reversal was recognized, how the recoverable amount was calculated, and what assumptions were used. Disclosure requirements are especially heavy for goodwill and indefinite life intangibles. This slide shows the full IAS 36 impairment model. We start by identifying impairment indicators, then estimate recoverable amount, compare it with carrying amount, recognize impairment, allocate the loss if it is a CGU, and finally reconsider reversal. A simple mnemonic to remember this is IECRAR. Impairment testing starts with indicators. External indicators include market decline, higher interest rates, or adverse economic changes, etc. Internal indicators include damage obsolescence, poor performance, or assets becoming idle. If any indicator exists, an impairment test is required. And then, once indicator exists, we estimate recoverable amount using either fair value less costs of disposal or value in use. If one of these exceeds the carrying amount, we can stop. No impairment is needed. And the third step is straightforward. If carrying amount is greater than recoverable amount, impairment exists. If carrying amount is equal to or lower than recoverable amount, there is no impairment. When impairment exists, the loss is recognized immediately. It reduces the asset's carrying amount and affects profit or other comprehensive income depending upon the asset. Depreciation must then be recalculated using the new carrying amount. Let's apply everything using a simple example. The asset has a carrying amount of 500,000. Fair value less costs of disposal is 430,000. Value in use is 450,000. The recoverable amount is the higher of 430,000 and 450,000, which is 450,000 of course. Since the carrying amount is 500,000, we recognize an impairment loss of $50,000. But the goodwill has special rules. It must be tested annually even if there are no indicators. Goodwill is allocated to CGUs and impairment losses reduce goodwill first. Reversal is allowed for other assets if recoverable amount increases, but never for goodwill. Impairment is identified at cash generating unit level. The loss is allocated first to goodwill, then to other assets on a pro rata basis. However, no asset can be reduced below its recoverable amount or zero. Always remember, goodwill takes the first hit. In this cash generating unit example, total carrying amount is $500,000 and recoverable amount is $400,000. So total impairment loss is $100,000. Goodwill is $80,000, so it is fully written off first. This leaves a remaining impairment loss of $20,000 to be allocated to other assets. The remaining $20,000 is allocated proportionately to machinery and building based on their carrying amounts. Machinery receives about $10,476 and building receives about $9,524. Now this is the journal entry for the cash generating unit impairment. We debit impairment loss in profit or loss and credit goodwill, machinery and building accordingly. These are the top 5 mistakes students make in IAS 36. Ignoring annual goodwill tests, using the lower value instead of higher, including future restructuring cash flows, reversing goodwill impairment, and allocating cash generating unit losses incorrectly. So you got to look out for these whenever faced with such a scenario. To conclude, remember these three key points. Assets must never be carried above recoverable amount. Recoverable amount is the higher of fair value less costs of disposal and value in use, and goodwill impairment is permanent. Thank you for watching, and I hope this session made IAS 36 clear and manageable.